Why are more countries moving away from the US dollar? For decades, the dollar's supremacy has been an unquestionable fact of global finance, but if you think that dominance is guaranteed forever, you need to watch this. Around the world, a quiet, deliberate transformation is underway. Governments and businesses are methodically reducing their dependence on the dollar. This isn't a dramatic, overnight abandonment. Instead, it's a calculated process of hedging, diversifying, and building alternatives. They are constructing a financial world with more options, more resilience, and a different balance of power. So, what's really driving this monumental shift? The answer lies deep within the plumbing of the global economy. The story starts with a complex web of incentives, the invisible architecture of global trade routes, the sophisticated calculus of risk management, and the raw dynamics of international power. While headlines focus on political rhetoric, the real action is happening out of sight. Balance sheets are being reconfigured, and the payment rails that form the circulatory system of global commerce are being quietly and fundamentally rewired. To understand where we're going, we must first look back. In the aftermath of World War II, the Bretton Woods Agreement established a new global economic order. It linked the world's major currencies to the US dollar, which was in turn convertible to gold at a fixed rate. The dollar became the world's anchor currency because it was stable, liquid, and backed by the unparalleled strength of the post-war American economy and its deep, transparent financial markets. This system provided the predictability needed to rebuild a shattered world. Even after President Nixon closed the gold window in 1971, severing the dollar's last link to the precious metal, its central role endured. A new pillar emerged in the 1970s, the petrodollar system. An agreement with Saudi Arabia and other major oil producers ensured that crude oil, the lifeblood of the industrial world, would be priced exclusively in dollars. This masterstroke created a constant structural global demand for dollars to buy energy, and a place to park the resulting profits: U.S. Treasury bonds. This recycling mechanism cemented the dollar's dominance for another half-century. So if this system has been so entrenched for so long, why shift now? The momentum for change comes from the convergence of three powerful forces: geopolitics, technology, and economics. First, and most urgently, is geopolitics and the risk of sanctions. The use of the dollar-centric financial system as a tool of foreign policy has sent a chill through capitals worldwide. The freezing of hundreds of billions of dollars in foreign central bank reserves and the disconnection of entire countries from the SWIFT payment network served as a stark demonstration. It showed that what was once considered a purely financial decision, where to hold savings and how to process payments, had become a profound source of political and economic vulnerability. The question echoing in finance ministries everywhere is no longer theoretical: just how exposed are we to a single point of failure? Second, there is a powerful drive for strategic autonomy. Large emerging economies from China and India to Brazil and South Africa are no longer content to operate within a system where their economic destiny can be constrained by decisions made in Washington. They desire more freedom to pursue their own national interests, conduct foreign policy, and manage their economies without needing implicit or explicit permission. Reducing their reliance on the dollar is not necessarily an act of hostility. It is a pragmatic pursuit of optionality and a declaration of economic sovereignty in a multipolar world. The third driver is technology. For decades, the dollar system was the only game in town, because there were no viable alternatives. That is no longer the case. Financial technology is rapidly making non-dollar routes not just possible, but practical and efficient. New cross-border payment rails, like China's CIPS and India's UPI, are being developed. Instant settlement systems are eliminating the need for correspondent banks, and perhaps most transformatively, pilot programs for central bank digital currencies, or CBDCs, are accelerating. These technologies promise to create a new financial architecture that is faster, cheaper, and operates entirely outside the traditional dollar-based channels. These forces are amplified by shifting global trade patterns. The center of economic gravity is moving decisively toward Asia and the global south. As countries trade more with each other, the logic of using a third-party currency like the dollar begins to fray. It adds cost, complexity, and risk. Consequently, invoicing currencies are starting to change. We're seeing more trade settled directly in Chinese yuan, Indian rupees, Emirati dirhams, and other local units, especially within specific sectors and regional blocks. The result is a powerful feedback loop. As more non-dollar trade experiments prove successful, they create the business case for investing in more non-dollar infrastructure. And as that infrastructure becomes more robust, it encourages even more non-dollar trade. So how does this de-dollarization look in practice? It's not a single event, but a mosaic of actions. It's a gradual, methodical process unfolding sector by sector and deal by deal. One key mechanism is the proliferation of bilateral trade deals. Countries are agreeing to settle transactions for essential goods like energy, food, or manufactured products directly in their own local currencies. This cuts out the middleman, reducing currency conversion costs and eliminating the exchange rate risk associated with the dollar. Central banks are also expanding their network of bilateral swap lines. These are agreements that allow them to exchange currencies directly with each other. In a financial crisis, this gives their domestic banks a reliable source of foreign currency liquidity without having to scramble for dollars on the open market, thus reducing the potential for panic and emergency demand for the greenback. In a clear signal of their intentions, many central banks are aggressively buying more gold. In a world of fiat currencies, gold is unique. It is a universally accepted store of value that is nobody's liability. It cannot be devalued by printing more of it, and its physical nature makes it a powerful hedge against sanctions, geopolitical turmoil, inflation, and currency volatility. At the same time, reserve managers are recalibrating their portfolios. While they still hold the majority of their reserves in dollars, they are steadily increasing their allocations to other currencies, like the euro, the Japanese yen, and increasingly, the Chinese yuan, alongside gold. Even a small percentage shift in global reserve allocations represents the movement of hundreds of billions of dollars, creating a slow but steady tide away from dollar assets. Finally, we see the rise of regional payment networks. Systems like the one being developed by ASEAN countries or the M-Bridge project involving China, Hong Kong, Thailand, and the UAE allow neighboring countries to settle trade and investment flows instantly and directly, without ever routing the transaction through US banks. This means lower fees, faster settlement, and greater control. The biggest test for de-dollarization, however, is the energy market. For 50 years, the petrodollar has been the bedrock of the system. Now we are seeing the first significant cracks. A landmark deal between India and the UAE saw oil settled in rupees. Russia is now selling the majority of its oil and gas in yuan and rubles. While most of the world's oil trade remains denominated in dollars, each non-dollar deal serves as a proof of concept, demonstrating that the system can function without it and potentially scale. From the perspective of other nations, the benefits of this diversification are clear. It lowers exposure to the political and economic risks of a single currency system, reduces transaction fees, and fundamentally increases national sovereignty. For businesses within these countries, being able to invoice and pay in their home currency simplifies operations and smooths out cash flow by removing exchange rate volatility. But this transition is not without significant limits and risks. The dollar still dominates for a reason. US financial markets are unparalleled in their depth, liquidity, and openness. No other market can absorb the sheer volume of global capital flows. Many of the alternatives, like the yuan, lack full convertibility and are subject to capital controls. Others lack the scale and legal clarity to be a true global substitute. A poorly managed transition toward a fragmented system could inadvertently increase transaction costs and introduce new forms of volatility. From the US perspective, the dollar's dominance confers what has been called an exorbitant privilege. It allows the country to borrow more cheaply, fund its deficits, and wield immense geopolitical leverage. But this privilege comes with profound responsibilities. Maintaining credible institutions, pursuing prudent fiscal and monetary policy, and ensuring open, transparent markets. Any missteps that seriously dent global confidence in America's ability to uphold these responsibilities could dramatically accelerate the diversification trend. What could speed this shift from a slow crawl to a rapid run? A few scenarios stand out. A major sanction event targeting a G20-sized economy could trigger a systemic flight to alternatives. A significant loss of faith in US fiscal discipline, perhaps sparked by a debt crisis, could erode the appeal of treasury bonds. A sudden technological breakthrough in cross-border digital settlement could make alternative rails instantly superior. Or, a critical mass of commodities beyond just a few cargoes could begin to be persistently priced in a non-dollar currency, breaking the petrodollar's grip. The most likely future is not a world without the dollar, but a multipolar currency world. In this scenario, the dollar remains a leading currency, perhaps still the first among equals, but it shares the stage with a more prominent euro, a more internationalized yuan, and a host of influential regional currencies. In this world, firms and investors will no longer default to the dollar, but will instead choose their currency based on the specific trade partner, the pricing mechanism, and their assessment of risk. For businesses, this new reality demands a new playbook. Corporate treasurers must prepare to invoice, pay, and hold cash in multiple currencies. They will need to diversify their funding sources and become more sophisticated in hedging against currency risk. This means building new banking relationships, integrating new payment technologies, and developing a more dynamic global financial strategy. For governments, the challenge is to strike a delicate balance between gaining autonomy and maintaining stability. This involves developing deep and liquid local capital markets, strengthening the credibility of their central banks and legal institutions, and ensuring they retain access to global liquidity, even as they build regional alternatives. In this new era, the technical details of financial plumbing matter just as much as grand political statements. To be clear, countries aren't fleeing the dollar in a panic. They are methodically and pragmatically building options for a future that looks very different from the past. The transition is slow, it is uneven, and it is driven by practical self-interest. But make no mistake, it is real. If you truly want to understand the future of global power, don't just watch the summits and speeches. Watch the plumbing. Watch the composition of central bank reserves, the topology of payment rails, and the currency of trade invoicing. This is where the real change starts, long before it ever makes the headlines. This isn't a single dramatic story. It is the story of thousands of small, rational choices being made by treasurers, investors, and policymakers around the world, all adding up over time to create a profound cumulative effect. The future of money will be more networked, more digital, and more diversified than at any point in the last 75 years. The era of unquestioned dollar dominance is evolving, and a new, more complex global financial order is beginning to take shape.